Hi, my name is Shamin and I'm a member of the Singapore Society of Actuaries. In today's video, I would like to talk about climate risks as well as how actuaries can contribute to ESG. Each year, the world emits about 51 billion tons of greenhouse gases onto the planet. If businesses do not change the way they operate now, no country will be able to achieve net zero position by 2050. Climate risks can help to break down the analysis of the consequences and likelihood of climate change. Climate risks can be broken down into physical and transition risk. Under physical risks, businesses are vulnerable to physical risks associated with climate change. This is, for instance, natural disasters. Specifically for non-life insurance companies, a single natural disaster can wipe out years of premiums. Additionally, rising temperatures can cause prolonged droughts in some regions and increased rainfall in others. Droughts and excessive precipitation can harm properties and human health. The most recent example of such physical risk was seen in the Europe 2022 heat wave. The increasing temperature across Europe resulted in wildfires and hundreds of heat-related deaths. In July 2022 alone, as firefighters battled more than 30 forest blazes across the country, most of Spain was issued a heat warning after the Carlos III Health Institute reported 360 heat-related deaths from causes like heat stroke. In such cases, insurers may raise insurance premiums for businesses at high-risk areas upon renewal, leading to higher operating costs for businesses. Under transition risks, policy enactment on new or higher carbon tax could increase the cost of business as we move towards low-carbon economy. Increasing customers' preference towards green products may also put carbon-intensive businesses at the risk of losing customers, especially the environmentally conscious ones. Next, more specifically, I'll move on to talk about climate risks in the insurance industry. The property and human health risks brought about by climate change would directly affect the frequency and severity of insurance claim amounts. This increase in claims might not have been expected by insurance companies during their product pricing process. To counter this, some insurance companies are seen refusing the provision of specific climate-related coverage to their customers. Secondly, other insurers are looking to increase their premiums for policyholders in high-risk areas. Increasing premiums beyond clients' expectations would lead to customer dissatisfaction and reputational risks if consumers deem such an increase to be unfair. This could potentially result in an increase in lapse risk within the insurance company and, in the worst-case scenario, bring about detrimental effects to an insurance company's solvency. Thirdly, beyond the non-life insurance industry, the life insurance industry could also see detrimental impacts due to the health problems brought about by air pollution. Regions with high greenhouse gas emissions could see their population facing a lower quality of life and an increased risk for major critical illnesses such as lung cancer, stroke, heart attack, and other life-threatening conditions. These could also inadvertently result in an increase in premiums for insurance companies to retain their profit margin or solvency ratio and could end up making such coverage unaffordable for the general population. If premiums are not reviewable, this could cause insurance companies to suffer from losses in these businesses. To get started on a sustainability journey, businesses need to first understand their carbon footprint. For instance, how much greenhouse gases the company is emitting to this planet. With this in mind, actuaries can help to make changes in the insurance industry. ESG could be considered in different actuarial function areas relating to valuation, pricing, as well as product development. In valuation, actuaries can help to develop more efficient valuation methods, for instance, with a reduced runtime in order to save energy and in turn save the environment. Pricing a product could consider more factors such as the different climate risk factors mentioned above to ensure that ESG considerations are taken into account. Lastly, actuaries in the product development department can help to develop products that contribute to a green cause or that would contribute to societal enhancement. As actuaries, I believe that we have the knowledge to help in this field. In the next part of the video, I'll be talking about a more specific example. For instance, building models to quantify ESG risk scenarios. Stochastic climate risk models could help to price in some ESG risk which might otherwise be hard to evaluate, such as uncertainty relating to global warming and sea level changes. Companies may further leverage on technology to remove limitations on traditional modeling methods. In a more specific example, I would like to talk about a storm damage simulation model that was built by my colleagues Kay and Amos here at Coherent, whereby a stochastic simulation method was used to model the probability of storm damage. This model was built into Excel. Such Excel-based stochastic models are still widely being used in the industry today due to Excel's flexibility in defining parameters, although runtimes might be slow for larger and more complex models. In this case, technologies such as Coherent Spark can take said Excel logic and convert it into an API, drastically reducing runtimes. With the above-mentioned model as an example, I believe that with greater focus on environmental issues, actuaries can help to bridge the way to a greener tomorrow, one step at a time.